to welcome our presenter, Mary Jovanovich, Senior Relationship Manager at Schwab Charitable, and our Rhode Island representative, Rebecca Allen, Vice President and Financial Consultant for Charles Schwab. Thank you both for sharing your expertise with us about this interesting and timely subject. Mary will share a PowerPoint presentation with us lasting about 35 minutes. Attendees have been muted and your images are not shown to protect your privacy, but you can submit questions in the chat box, which appears when you move your cursor over the bottom of your screen. Mary will answer questions after she has finished. We are recording this talk and we'll have the link available so that you can review the material later. Rebecca, at this point, I'd ask you if you would introduce Mary.
Thank you, Chuck, and good afternoon and welcome. I'm Rebecca Allen from the local Schwab branch here in Portsmouth, and I'm pleased to be joining you to introduce my partner and colleague, Mary Jovanovich from Schwab Charitable. I've had the opportunity and privilege to partner with Aquidneck Land Trust for the last few years. I've always admired the organization, the work they do and continue to do, and I've enjoyed the open space the Land Trust makes available for our communities to enjoy. This year's been so different for all of us, and notably for organizations like Aquidneck Land Trust. The challenges that have come about in staying connected with members and donors and fundraising efforts that are vital to the futures of those organizations. I was thinking back to the ALT annual meeting earlier this year in February. A lot has changed since then. This environment has given each of us the opportunity to relook at how we're doing things and to consider new, different, and creative ways of approaching the goals and tasks that are part of our lives. It's been great to hear how successfully ALT has adapted and reinvented events like Fiesta Verde, now Evening at Home. I know Schwab had participants in the recent golf outing and they thoroughly enjoyed it. Clearly, this new environment has been a perfect opportunity to enjoy outdoor space, and it creates even greater opportunities for ALT going forward. And while I'll be missing one of my favorite events this year, the Race for Open Space, I do look forward to what lies ahead for the remainder of this year and into next. I already have November 6th, 2021 on my calendar and can't wait to gather near the Polo Grounds for next year's race. In the meantime, I plan to get out to enjoy this iconic Greenway Trail, and I hope everyone else out there does too. I think the content of today's presentation will give each of you some useful guidance to review your own planned giving strategies, as well as an opportunity to consider other organizations you may be involved with that may benefit from similar content and information. And with that, I'd like to introduce my partner and colleague, Mary Jovanovich. Mary's been with Schwab for over 10 years and joined Schwab Charitable in 2015. She works closely with our financial consultants to incorporate charitable planning into our wealth management strategies. She's an inspiration with her own philanthropic work. She's enthusiastically involved in her community in Indianapolis as secretary for Dress for Success and serving on boards for the Integrating Women Leadership Foundation and Indiana Wesleyan alumni. I should mention she holds her master's degree from there as well. Mary's a volunteer at Coburn Place and the Him by Her Foundation. She's pursuing a graduate certificate in philanthropic studies with Indiana University's Lilly Family School of Philanthropy. To me, Mary is a trusted and valued colleague who offers tremendous support in speaking with and guiding organizations that are local here in New England and are also near and dear to our clients and to our communities. Thank you, Mary.
Thank you so much for that tremendous and very kind welcome. I'm going to go ahead and share my screen so that we can have a conversation. And that's what I really would like this to be today. So what we're going to start off with is just charitable giving strategies. And today's goal isn't to convince you to, buy something or do something. It's really to plant the seed. That's all I'm trying to do today. I want to bring to your attention some different ideas, some different charitable vehicles or tax strategies that you might want to consider for your own personal philanthropy so that you can take it further and have a greater impact. So what are we going to talk about today? Well, first, I'm going to talk about charitable planning as an investment strategy. And then I'm going to talk about understanding the various giving vehicles that are out there, because you do have a lot of options. Then I'm going to identify 5 strategies that you might want to utilize to maximize your impact. It could be one or all of them. And then where can you go for help and resources? So let's go ahead and get started. What do I mean as charitable planning as an investment strategy? Well, life events are happening. I know that there's a lot going on today with COVID, with social unrest, with political news of who's going to get elected. There's the fires out in California. We've had some hurricanes. There's been some issues in Beirut. So there's a lot going on. But no matter what, life goes on. So you might actually be thinking about different events that could trigger a need for a charitable donation. First and foremost, of course, is that annual giving. And we all know Giving Tuesday is coming up. It's going to be December 1st of this year, so it's just around the corner. It could be a liquidity event. Maybe you're holding on to an appreciated asset. Maybe you bought some stock a couple of years ago and it's appreciated, or through an inheritance, you received a concentrated position. And you don't want to sell it because you don't want to pay the capital gains tax, but you also don't want to hold on to it any longer for various concerns, whether it be to mitigate risk because it's a concentration, whether it be a market pullback. There could be the potential for you to avoid those capital gains tax if you use it for charity. It could be a major life transition. Maybe you own a business or you have a piece of real estate and you're getting ready to liquidate that, or getting ready to retire. There are reasons why you might want to use charitable giving in that action of your life. And then finally, there are those individuals that are thinking about their estate and legacy planning. And you don't have to have a significant amount of wealth to think about your legacy planning, because what I'm talking about is what do you want to have as an impact on this world, and how do you want to be remembered? And maybe that's one of the strategies of charitable giving that you want to incorporate in your own personal life. So, as with any investment strategy, there are key strategies to maximize your charitable impact. First, it's understanding that giving vehicle option. And the reason that's so important is because different giving vehicle options offer different tax deductions. So, for example, if you use a donor advised fund account and you donate Apple stock, the value of your charitable deduction can be up to 30% of your adjusted gross income. If you take that same stock and put it into a private foundation, it's only 20% of adjusted gross income. So that's why it's important to understand the different giving vehicle options. Next, we would want to consider the best asset. Typically, cash is the least efficient way to give. Using an appreciated asset like a stock can help you avoid capital gains tax, which could potentially increase your gift by 20%. Timing could be crucial, and I'll go over an example of what I mean by the timing example. And then ideally what's going to happen is once you get all of these factors into play, you're going to increase your giving satisfaction, because now you're going to be actively engaged in the process versus just writing a check or utilizing a credit card. But most importantly, it's really important for you to engage with your tax advisor. But I actually like to point out all your advisors. And when I say all of your advisors, what I mean by that is, of course, your tax advisor, potentially your attorney, the nonprofit directly, and your financial consultant, and most importantly, your family. Those are all the advisors that you'll want to consider when you're talking about these types of strategies. So how do you select your giving vehicle? Well, we look at it from 3 different perspectives, and we look at it from the perspective of the giving horizon. Do you want to give directly now? And if that's the case, maybe utilizing cash or check or doing a direct stock transfer might be most beneficial for you. But if you're thinking about giving over time and you want to be more proactive and strategic with your giving, you might consider a donor advised fund account, the private foundation, or working with your local community foundation. But then there are those individuals that while they want to be philanthropically inclined, they don't have the capacity to give quite yet. They still need that money because they need it as a source of income. And so for those individuals, they might want to utilize a charitable trust or a charitable gift annuity. That way they can earn income. And we'll drill down on each one of these in greater detail. So let's look at these different giving vehicle options and what their benefits are and the differences between them. First, private foundations. Private foundations require that you work with an attorney because you're going to actually draft a legal document to establish your foundation with the local Attorney General's office or Secretary of State. And the reason that people create private foundations, the most common are maybe they have a child, like a husband and a wife. I'm working with a client that did this recently. And their son wants to be a full-time musician, but that salary isn't going to sustain his living expenses. One of the things that they were able to do is they created a private foundation, and the son oversees the administration of that foundation. As a result, he gets an income for being the administrator of that foundation, in addition to his salary that he gets as a musician. Collectively together, it gives him the opportunity to have a very nice lifestyle, and he's very happy, and the parents are happy. Maybe you want to loan money to charity, or maybe you want to be able to establish a scholarship and handpick a scholarship recipient and review the applications for that scholarship. Those are some of the reasons people use private foundations. One of the things you need to keep in mind is if you establish a private foundation, you're not private. All of your information is publicly known, and it's all out there on the internet. All anyone has to do is a 990 search, and they can find out about your private foundation. And in addition, you're mandated by the IRS to give 5% out annually. And so that's something to think about. The cost can be expensive depending on how you've established the account, but administrative, if you're looking at $1 million, the administration fee on that can vary between 2 to 5%. Next, let's look at a community foundation. And I absolutely love community foundations, especially now because of COVID. A majority of them have established COVID relief funds, and so they're supporting those individuals locally that need that assistance right now because of losing their jobs as a result of COVID. So maybe you need some more guidance. Maybe you don't know what charities you want to support, and maybe you want to understand what the real issues are for you in your local community. Here in Indianapolis, it's very unfortunate. We are second in the nation for teenage suicide rate. But if I go across the border to Ohio and just go to Akron, Ohio, their number one concern is infant mortality. And so they're working on different initiatives than what we're working on here in Indianapolis. That's where you can have a direct impact to improve your local community. The other thing a community foundation can do that I can't do is actually give you a tour of a nonprofit. So maybe there's some more information that you need and you really want to understand what that mission is. That's where a community foundation can be of great service. And finally, and why I'm a part of a community foundation, is because of giving. I'm able to give from my donor advised fund account to the local community foundation's giving circle. I'm in the Sage Society as one of the 3 that I'm in, and my $1,000 is combined with other women's dollars. And now we're able to give $100,000 out into the community. So my $1,000 has a greater impact when it's collectively combined at the community foundation. On $1 million, you're typically looking at an administrative cost of between 1 to 1.25%, to put that into perspective. The deductions are going to be identical to that of a donor advised fund, so we'll cover that next. You would want to consider a charitable remainder trust if you want flexibility and the ability to generate a lifetime of income stream. And what's nice about this is you have control over the intended charitable beneficiaries. Now, the way that this is deducted, it's very complicated, and there's a very specific formula, and there's a lot of factors that go into it. So as I stated earlier, if you're giving stock to a private foundation, it's 20% of adjusted gross income. And if it's going into a donor advised fund account or a community foundation, it's 30%. I can't offer you that same comparison. It's impossible for me to do an apples to apples comparison with a charitable remainder trust, but I will let you know you can get a deduction for that type of donation. A charitable annuity is going to be very similar as a charitable remainder trust. The difference is that typically a gift annuity is established with just one organization. That's typically the way that it works. It might be a good option if you want an immediate charitable deduction if you itemize. And so there's the difference between the charitable remainder trust and the gift annuity. The charitable remainder trust, the deduction can be taken over time. With the gift annuity, it's up front. So that's something to think about. Now let's talk about a donor advised fund and why they're growing in such popularity. I can tell you that when I joined Schwab Charitable 4 years ago, assets under management were $8.1 billion. And now, fast forward to 20, assets under management are over $18 billion. But in that same time period, our donors have remitted out over $8 billion. So why is that growth happening? Well, there's a couple of different reasons why that's happening. First is the markets. Let's be honest. The markets have done really, really well the past 10 years. I know this year it's been a little bit volatile with ups and downs, but in general, it's been very steady when you look at the history over the past 10 years. So what makes a donor advised fund so advantageous and so desirable for people is that you don't need that attorney to create the foundation, but you can call this account your own family foundation. And you can start it with as little as $5,000 and it doesn't need to be maintained. Now, each donor advised fund, depending on where you establish it, will have their own rules and regulations and their own opening balance requirements and their grant minimums and things of that nature. But at Schwab, I can say that we're the lowest in the industry when it comes to administration fees. And I can also say that our balance minimum and granting minimum are the lowest as well. So what do you want to think about and why would you want a donor advised fund account, whether it be with Schwab or with the local community foundation? Well, the most important thing is that planned gifts can be made in the tax year when they're most advantageous. So maybe this year you're going to have a terrible tax burden. Well, I'll go over a strategy called bunching that can actually be to your benefit. And that goes back to that timing concept of you're not going to give more money, you're just going to give it sooner rather than later. You can recommend to any 501c3, qualified 501c3. So when, where, and how much is your decision. The administration and record keeping are done by Schwab Charitable, and you have the ability to grant the money very quickly and very easily, either online or through your mobile app, and it's going to work just like a bill pay system. Now, what's the biggest difference between a donor advised fund and a private foundation besides the tax deduction? It's going to be ownership. Once you give money to a donor advised fund, it's an irrevocable gift. It can never go back to your personal possession or be passed on to a family member. It has to go to a 501c3 at some point in time. That's why the deduction is higher than a private foundation, is because you are actually giving up ownership. The other thing to think about is that, again, you don't have to have a large amount of money to establish it. But if you wanted to call it a foundation, you have that ability to do that. The only word you can't use in the title of your account is the word trust, because they don't want it to be seen as a trust fund. That's an IRS term, and it has legal connotations to it. So should you get one or the other? Well, actually, you can actually have them all working together. And we do have some donors here that have all three. As I stated, I use my donor advised fund to support the community foundation. I have people with private foundations who don't want donations to be known, so they put money over to the donor advised fund account so that they can remain anonymous. I have people with the community foundation account that will come to me because they want to do international granting. So the decision actually has a lot to do with the level of privacy, how much you want to optimize tax deductions, if you want to grant outside the mission of the foundation, how quickly you want to grant and how much do you want to grant. If you want to be flexible and do smaller grants of $50 or more, the donor advised fund is a better option. And in all cases, there is the ability to engage future generations. One of the things that people with private foundations will do is, prior to family members taking on that administration responsibility of the private foundation, they'll open up a donor advised fund to sort of test the waters and help them better understand how to utilize a private foundation in the future. So what is a donor advised fund account? Is it a financial planning tool? Is it an investment account? Or is it an alternative giving vehicle? Well, the answer is all three, and here's why. When you open up your donor advised fund account, as I stated, you get to title it however you'd like. So if you'd like to utilize the word foundation, or if you'd like to utilize the word giving fund or charitable fund, you can do that. I have other donors that don't want their name associated with the account in any capacity, and so they call it the Give It All Away Fund, the Share the Love Fund. And for those of you who've ever watched Seinfeld, the Human Fund, we actually have an account here under that name. Other people are religiously inclined and they'll use biblical verses. I have other people who will use poems. I have a client who loves Maya Angelou, and she utilized the phrase "rise up" in her fund account. So what you'll do is you'll title your account. You're going to establish your account online or in a paper application. And then what you can do is, when you open up that account, Ideally, you're going to deposit an appreciated asset, and here's why. When you do that, you avoid the income tax, you avoid the capital gains tax associated with that appreciation. And in addition, if you itemize your tax return, you can claim a charitable deduction. Now, once the proceeds go into the account, you have the ability to invest it. And there are different ways that you can invest the money. And so ideally what will happen is when you invest that money, it's going to grow tax-free, meaning that you get to give more money away to charity. There's no additional tax benefit, or you don't need to report anything on your tax return on that growth. It just means that you get to give more money away. But more importantly, and the fun part, you get to grant over time. You decide who, when, and how much. And again, at Schwab, it's a minimum of $50. Now, a common question that I'll get asked is, Mary, I've opened up this account. What happens if I die? What happens to the money? Well, again, you get to have the ability to create your own succession plan. And those succession plans can look like this. You could identify other individuals, like family members, maybe a son or a daughter, maybe a close friend, and they could be successors. Again, they can't take the money personally. They get the ability to give the money away on your behalf. Or you can name a charity directly, like the Aquatic Land Trust. You could name them as one of the beneficiaries of your donor advised fund. The other opportunity that you have is for those individuals who may not feel comfortable giving a lump sum dollar amount to a charity. I have a lot of people right now, as a result of COVID, they realize the importance of creating an income stream. They might actually consider the legacy program, and the legacy program would require $100,000 or more. So now, instead of giving a lump sum, people are creating an income, and they'll remit between 5, 10, 15, 20% of the account annually to give that money to the charity so that they can budget better for it. And I think we all know a lot of charities have suffered this year as a result of not hosting their annual galas in person. Some adjusted very well, like the Aquatic Land Trust, and others have not adjusted so well. So let's look at the power of a donor advised fund account, or actually just donating a stock directly to a charity. So in this example, let's pretend for a moment that back in February of 2006, we all knew to buy Apple stock before the iPhone was invented. And Apple stock back then was trading at $8.26 a share. Fast forward, I was working with a client in December of 2017, and he utilized that stock purchase for a donation into his donor advised fund account. At the time he donated on December 27th, 2017, that $8.26 a share had actually appreciated to over $230 a share. He didn't want to pay Uncle Sam any capital gains tax, but he was very philanthropically inclined. So he deposited it into his donor advised fund account and gave that money out to charities of his choice. So in this example, let's all go back to 2006. We put $5,000 in, and now all of a sudden it's accumulated and it's worth $100,000. All of us on this call would be facing capital gains tax of $95,000 on the gain of the potential capital gains on the growth of the $95,000. In this scenario, we're in the top tax bracket of 37%. If we didn't know about giving the stock directly, or if we didn't know about donor advised fund accounts, and we just decided to sell the stock and write a check to the Aquatic Land Trust, what will happen for you personally is you will actually be able to claim the value of a charitable deduction less the capital gains tax paid. So you will pay Uncle Sam that $19,000 in capital gains tax. You will be able to take off on your tax return $10,970, and you get to give the Aquatic Land Trust $81,000. And I'm sure they would love that. However, if you'd open up a donor advised fund account, or if you'd give that stock directly, because it's the same regardless of how you do it, your value of your charitable deduction now goes up dramatically to $37,000. So there's the immediate win for you. But more importantly, the win is for the charity, because now the charity would have $100,000. Some people will ask me, which is better to do? Is it better for me to give the stock directly, or is it better for me to open up a donor advised fund account? And the answer is very simple. If you are comfortable giving that full $100,000 out in this tax year, then donate it directly. Don't open up a donor advised fund account. It's not necessary. But if you're facing a very large tax liability and your CPA said put $100,000 into the donor advised fund, give it out over time, meaning 1 year, 2 year, 3 years, 5 years, 10 years, 15 years, 20 years, 50 years, that's where the donor advised fund account can be beneficial, because the deduction is based on when you contribute and not when you distribute. That's what's driving the growth in the donor advised fund. So what we like to say at Schwab Charitable is that tax savings equals more money for charity. But what I like to say personally is that you're creating a culture of caring. And here's why. You win immediately. You can see the value of the charitable deduction going up. Your charity wins immediately. It means that they can serve more people and offer more programs. And those individuals will go home and touch other people's lives. So the net that you're casting is far greater than yourself. And that's how you create a culture of caring. So how do you recommend a grant? How do we start to have the fun and actually experience the joy of giving? Well, as I stated earlier, it's very simple. It's going to work very much like a bill pay system. So, and this is true with most of the sponsoring organizations of donor advised funds. You'll go online and you'll craft a gift letter, and then you'll submit it, and then it will be remitted out with the check to the charity. So what does that look like? Well, here's where the fun is, and this is where you can get more engaged with your giving. And I know from my own personal experience, it's actually engaged my husband. In the past, I had always been the one being thanked for the donations because it was my signature on the check. It was my credit card being utilized. Well, when we got the donor advised fund account, I'd never realized that in 20 years of marriage, and I've been married for 24 years now, that in 20 years of marriage, my husband had never been thanked for a gift. Even though it's our money combined, I had always received the thank yous in my name. And the first time that he received a thank you, he pointed that out to me. And so it actually has me more engaged with our giving now as a result of that personal experience. So what you can do is you can customize the letter. You can remain completely anonymous. You can just give your account title, like the John and Mary Client Test Charitable Fund, as what's shown here on the screen. You could just say that it came from John Client or from Mary Client. You can give your address or not give your address. You can actually designate how the funds are to be utilized. So maybe it's an annual appeal, or maybe it's something else that you want to support. So there's the opportunity for you to customize and really be more intentional with your giving to experience that joy. So now that we've talked about the nuts and bolts of how it works, let's look at some additional tax strategies that you might want to consider with your giving impact. First, we've talked about giving appreciated assets to charity. Some other things that we can accept besides publicly traded securities are private equity, cryptocurrency like Bitcoin, real estate, whether it be residential or commercial, limited partnerships, an S corporation, a C corporation. We've done some fun gifts like a Maserati collection, a quarter horse, interest in the Diamondbacks and the Vikings. And I'm currently working on a donation of gold bars. And that's been very fascinating to learn about how gold can either be a collectible or a currency. I had no idea that there was a difference between the two. The other thing that you'll want to do is track and itemize gifts to benefit from the charitable deduction. So keep in mind that this year, and this is really important for those individuals who are going to do the standard deduction, the CARES Act changed something dramatically. So if you're married filing jointly, the standard deduction is $24,800. But if you would give $300 directly to ALT, now what you're going to be able to do is that standard deduction is going to increase to $25,100. So that gives you the ability to take an above the line charitable deduction for $300 if you take the standard deduction. So keep that in mind. For other individuals, you might want to actually give a cash gift in 2020. Because let's say, for example, your adjusted gross income is $100,000. You're going to owe taxes on that $100,000. But if you have the capability and the means and you give ALT $100,000 directly, you can actually wipe away your tax liability. Now, there's some reasons why you might want to do that or not do that, and that's why you want to consult your CPA. But those are some things to think about as it relates to the CARES Act. Now, that 100% adjusted gross income deduction for cash donations, it can't come to a donor advised fund account and it can't come to a private foundation. If you were to give cash to your donor advised fund account, you're still going to be subject to those tax benefits we received as a result of the Tax Cuts and Jobs Act. So that's going to be 60% of your adjusted gross income. And then if it's a combination gift, it would be 50%. Qualified charitable distributions. Even though you don't have to take a required RMD this year, you still might want to take a qualified charitable distribution. Because why do you want to use money that you've already paid taxes on? You can actually take this from your IRA if you're 70 and a half and older up to $100,000 and give those proceeds to ALT, for example. And by doing so, you eliminate the ordinary income tax on it. So you're able to withdraw it without paying taxes. But more importantly, it's going to reduce the value of your IRA and ultimately estate taxes. But more importantly, it might actually lower your income, which has a direct reaction to what you pay for Social Security and also your Medicare B and D premiums. So those are things to think about as it relates to the qualified charitable distribution. And those who are doing the standard deduction as opposed to itemizing, maybe you want to utilize this bunching strategy. And this is where the timing one comes into play. So what I'm saying here is that here in this example, a married couple filing jointly with no children. I'm not asking them to give more money. I'm just asking them to time the donation differently. So no matter what's going on in their life, they're going to give $10,000 annually. And if they take the standard deduction, you'll see that when they itemize or when they look at their deductions and they add them up together, they have got their charitable deduction and their other deductions, whether it be state, real estate property taxes, mortgage interest, medical bills, that totals $13,000. Collectively in 2019, that's $23,000. Well, logically, you would take the standard deduction since $24,400 is greater than $23,000. And if they did it again in 2020, it would still, the standard deduction is still higher. So that 2-year collective total is $49,200. But think for a moment. What I'm asking you to do is put the money in sooner rather than later. So let's go ahead and put that $20,000 in 2019 because you know you're going to give it away in 2020. Now what you're going to be able to do is itemize, and here's where the tax savings happens. Now that you've itemized in 2019, when 2020 happens, you're not going to put any more money into your donor advised fund. It's there. You're going to be able to give it away, and then you're going to take the standard deduction. Now the 2-year collective total is $57,800. That's an additional $8,600 of additional tax deductions, all because you timed it differently. You didn't give more, you just timed it differently. And finally, for those of you who want to invest in socially responsible causes, there are some options that enable you to do that within the core account and the investment pools. And those for you who plan to itemize, these are some things to think about. And this is where you should be having conversations with your financial consultant and also your CPA, because we're coming to the end of the year. In another week, you're going to have 10 months of knowing, where you might stand from a tax liability standpoint. So if you're thinking about rebalancing your investment portfolio, if you're looking at potentially selling a concentrated position, maybe you won the lottery this year and so you have a large windfall, or you're going to sell a business, or maybe you've already done that. For those of you who might have taken advantage of the market pullback in March of this year, you might have converted some of those IRA assets over into a Roth conversion, or maybe you're just withdrawing from your retirement accounts. This is where charitable giving can actually help alleviate some of the burden with the taxes associated with these types of events. So have those conversations with your financial consultant and also your CPA to mitigate and pay the least amount of tax possible. And then finally, resources. Where can you go? Well, of course, we have Schwab Charitable for online resources. So if you'd like to learn more, you can go there. If you want to see how other donors are utilizing their account, we just celebrated 20 years. So we have 20 different donors with 20 different stories. You can, of course, go there for more information. And now what I'm going to do is I'm going to turn it back over to Chuck, because I want to have him talk about the planned giving and the opportunities that you have there as well. Chuck, I think you're still on mute.
Thanks, Mary. I just wanted to ask you where I register for the gold bar gift. We're very interested in that. So before we open it up for questions, I'd like to tell you about ALT's planned giving circle called the Green Island Society. We acknowledge any donor who has made their gifts known to us regarding any type of planned bequest to benefit our land conservation work. So a lot of the work, a lot of the tools that Mary was talking about could be a part of our Green Island Society. We don't ask for anything in writing, but only strive to thank and honor those who have kept ALT in their estate planning. If you are interested in the Green Island Society and finding out more about that, I would offer that you can contact Laura Friedman Pedrick, our development director at ALT, and her number is on the screen. It's 849-2799, or at her either at our website or at her email address. Sorry. So give that a thought, and we will now open it up for questions.
And while we wait for questions, I just want to piggyback on what you just said, Chuck. One of the things to think about as you're looking at your estate is that identifying a nonprofit to an IRA can be more advantageous than maybe if you're thinking about donating stock from your personal account, because what can happen is upon your death, your heirs will get the step-up basis. So that appreciation that you're normally worried about during your lifetime isn't going to apply to your heirs when it's outside of a retirement account. But when the money's in a retirement account and it's going to your children, for example, that stretch IRA is no longer available. So now they have to take that money out within 10 years. And that can cause some significant tax liability for your children. So definitely when you're thinking about your estate planning, really have really good conversations with your financial consultant, as well as your CPA and your estate attorney, to make sure that you're utilizing the best asset as it relates to potential estate taxes.
So I have a question. It's Nancy Jameson.
Hi, Nancy.
Hi. So many of us have committed to providing ALT a specific amount of money over the next 5 years. Mm-hmm. And most of it's, somewhat significant. And I'm just wondering if putting that into a fund, a donor advisor fund, mm-hmm. would be the right thing to do, or do like what you said and put it, do 2 years early and then have the tax advantage. How would you handle an ongoing commitment for a 501(c)(3)?
Yeah, that's a great question, Nancy. And so I look at it from a couple of different perspectives. So the first perspective is if you wanted to take advantage of that bunching scenario, that's something that your CPA could help you with. And then if you didn't want to take advantage of the bunching strategy, it's a question about when are you comfortable giving that money away? So do you want to be able to give that money away in those increments and stay invested? So let's say, for example, I'm just going to keep utilizing Apple stock in my example. So let's say that your commitment is that you've committed to give, $15,000 annually over the course of the next 5 years. So do you want to give $15,000 now of Apple stock directly and you get the same tax benefit? Or do you want to put more than $15,000 into the donor advised fund? And let's say that you put $20,000 there, and now you can satisfy that $15,000 commitment, but then you can be more efficient and effective with your other giving and have it all under one umbrella. So it's really about a matter of preference and when you want to give up ownership and whether or not you want to take advantage of some of those tax strategies. And so we could discuss it further if you'd like, but it just depends on what you're most comfortable with, to be quite honest.
Okay, thank you.
You're welcome.
And Mary, we have a written question. Are there any options for U.S. savings bonds with accrued interest?
You know what? That is a great question. So you can't give it directly to, and what I'll do, Chuck, is I will send you over this information so that you can send it to this individual. So you can't give U.S. savings bonds directly to a donor advised fund account. But there are some things that you can do. One of the things that you might want to consider this year, remember how I talked about that if you give cash, you can eliminate the tax liability associated with it. So if I were this individual, I would give my CPA a call. I would make sure that my CPA knows how much I have in U.S. savings bonds. So again, I'm going to go back to that $100,000 scenario. So let's say that your adjusted gross income is $100,000 and you cash in $100,000 on your savings bonds. You're going to have to recognize that growth from the savings bonds, and that's going to have an impact on your adjusted gross income. But if you turn right back around and give that $100,000 that you redeemed, you don't owe any taxes on that because you've eliminated it from your adjusted gross income. So what your CPA can do is your CPA can run some numbers for you. If you're not comfortable giving all of that at one time because maybe you still need to rely on that as a source of income, there is a way that you can donate it after your death to a charity. And so I'll send that information over so that that donor has that information and then can have conversations with their family members and their advisors to determine what's in their best interest. But that's a great question.
Thank you. Do we have any other questions?
I have a question, Mary.
Yeah.
I noticed on one of the slides that it referenced that state and local taxes weren't part of the assumption. Does the state of Rhode Island, or in your example, in Indiana, is that, does the state not give you a charitable contribution if you open a donor advised fund the way that it would if you were making a charitable contribution?
It's not so much the deduction, it's what you have to, the reason that we don't include state information in there is because every state is different. It really comes into play with estate taxes and what you can eliminate from an estate. So I know that I was doing a presentation yesterday with Seattle, Washington, and Seattle, Washington, you're not going to really hit the federal estate taxes, but if you have some wealth, you're most definitely going to hit the state taxes on estates. And so the reason that we don't include it is just because it's really complicated to put that in the formula. I will say it doesn't impact your federal. What I showed on the screen was the federal, and then what you're able to do from a state perspective is determined by each state. It's just like a 529 contribution. Some states give a better tax advantage for 529 contributions than other states. So I know Ohio, I'm originally from Ohio. Ohio isn't as favorable as Indiana. Indiana, it's like a dollar for dollar. Like it's an above the line deduction when you contribute to a 529. So charitable giving kind of works in a similar fashion. It just depends on what the state permits.
Okay, thank you.
Any other questions? Well, I want to thank Mary and Rebecca for coming on and giving us their expertise. This presentation has been recorded, so we will have it available for any of the attendees, but anyone else as well to look at it at a later time and to reach out to these consultants if that becomes something that you want to do. But I really appreciate this presentation today by Charles Schwab. Thank you so much, Mary and Rebecca.
Well, thank you. And I just want to say one final parting thought is I know that we talked a lot about giving, but to be a philanthropist, it doesn't mean that you have to give cash. There are all kinds of ways that you can give back. And so some other ideas to think about is donating your time and your talent in addition to your treasure and to your testimonies and your ties. So telling the story, that can be huge. Let people know what you've experienced and why you're involved. That can actually enable them to cultivate other donors. So it doesn't always have to be about cash. And some of the greatest gifts nonprofits get are those testimonies in addition to time and talent. So if there's something that you can do, volunteer, offer your time and talent to those organizations that you're passionate about.
Thank you, Mary. That's a great point.
Thank you very much. Very helpful information today.